So it's a nice time we meet again for a session of financial reporting. So my name is Edwin Ochoy. So for today, we are going to talk about insurance firms. And to talk about these insurance firms, we are going direct to do a question of August 2009. So let us look at the question so that we can be able to understand when there's insurance firms in an exam of financial reporting, what are you required to do for you to get these some of the free marks which are obvious provided there. So they were saying that the following information relates to the King Insurance Company Limited for the end of 31st December 2008. So trial balance as at 31st December 2008. That is the one which is given. We have ordinary share capital, evaluation reserve, retained earnings. We have an earned premium reserve. We have a net earned premiums, net commissions paid, net claims paid. We have a net claims outstanding. Those dates are important. The dates you can see there, they are in brackets. Like now, 1st January 2008, under net claims outstanding. We have management expenses. We have bad debts written off, treasury bills, treasury bonds, deposit in banks, motor vehicle at net book value. We have equipment at net book value. We have amount due to other insurers, amount due from other insurers. We have a bank overdraft. We have investment income, and we have other income. Additional information. Management expenses are to be allocated to fire and marine businesses on the basis of net earned premium. However, an amount of shillings 150 million of the management expense is to be charged to the profit and loss account for the end of 31st December 2008. Number 2, provision for an expired risk as at 31st December 2008 are to be maintained at 50% and 80% of the respective net and premium for fire and marine businesses respectively. So depreciation on motor vehicle and equipment is to be provided on a reducing balance basis as at the rate of 20% and 10% per annum. Net claims outstanding as at 1st December 2008 was follows. So what they require is all about the revenue account, income statement, and a statement of financial position. That is what is required in the exam by a student to do in any insurance question. You have to understand on how to do a revenue account, income statement, and a statement of financial position. That is the maximum they can test you in this topic. So we can start from the revenue account. So this is a question of 2009. So it's August 09. So we start from the respective revenue account. So I would say here, it was a King Insurance. So the King Insurance Company. So it's the King Insurance Company. So we need the revenue. Revenue account. So the revenue account is for the year. That is for the year ended. So it was for the year ended. Our financial year was ending 31st December 2008. 31st December 2008. So for this question, remember that the risk against which maybe the insurers were insuring against for this question, that is The question will guide us. So you can see mostly it is concerning the risk against which the insurance under this question they insured themselves against. Like now they say King Insurance Company Limited for the the following information relates to King Insurance Company Limited for the ended 31st December 2008. So we have so you can see like now the risk is mostly you can see in most of the areas we have fire and marine. Fire and marine, fire and marine. Like now under unearned premium reserve, we have fire and marine. Under net earned premium, fire and marine. Under net commissions paid, fire and marine. So it means that it's fire and marine. So it's fire and marine. But I said it's not a must that it must be fire and marine. It can be a different thing. So we always start from premiums. We always start from premiums. We always start from premiums. So for the premiums, we start from net earned premiums. This is according to this question. Because for the other questions, maybe if you have a direct premium received, you talk about them. Reinsurance premium received, you record. Reinsurance premium paid, you subtract. Outstanding premium balance brought down, you subtract. Outstanding premium carried down, you add. You get your net premiums. You talk about unearned premium reserve for an expired risk brought down and unearned premium reserve carried down. So for now, according to this question, there was such information was not present. So this question was a bit narrowed down. What we have, where I will start from, is this net and the premium. Because once you do all the information I have talked about is when you get this net and premiums. When you talk about this thing here. So what I mean is this. So what I mean is this one. So when you do so remember, in order to get a net and premium, you do this. You do this. You do what is here. So in some questions, you will find that you are given direct premium received, reinsurance premium received, that is from another insurance firm, reinsurance premium paid, you pay to another insurance firm, outstanding premium balance brought down, and outstanding premium balance carried down, so that you get net premium. But for this question, we are already given the net premium. That is where I have started from. But in some questions, you have to do all that. It's all about picking direct from the question. You just record, you subtract, and the others you add, you get to a net premium. But if we are given net premium, we continue from that point. So the net premium which was given there is 104. This is 7510. And the other side is 1945. The 920. Then after that, we continue with what? We continue with unearned premium reserve. Of which unearned premium reserve, I said, what is that? Someone who can be able to say it? Because after getting net premiums, you talk about unearned premium reserve, brought down and carried down. What is an unearned premium? What is an unearned premium reserve? So another premium reserve, as one of our students has said, it concerns the premiums which are set aside by the insurance firms to cater for that amount which is set aside anyway. It's an amount which is set aside to cater for the premiums which the insurance firm might not receive from the insurers on a certain period. So that amount we need for the unearned premium balance brought down, we add. So unearned premium. So unearned premium reserve balance brought down. So this one is given direct. So it's 300,000 and this is 750,000. Then under the additional information, they have said that there's a provision again which has been made by the end of the period for the unexpired, or we call it unearned. Sometimes they call it unexpired premiums for the unexpired risk. So that's why I'm saying that unexpired. When we hear the word unexpired, it's the same that they are meaning it's unearned premium. So provisions for unexpired. It's provisions for unexpired. Provisions for unexpired risk. So balance carry down. So I've said in some scenarios they can say that provisions for unexpired risk. Right now, what they have said here, or they say unearned premium reserve. So they say it was based on 50%. That is according to the additional information. 50% and 80% of the net and the premium. So that is according to note 2. Provisions for unexpired risk as at 31st December 28 are to be maintained at 50% and 80% of the respective net and the premium for fire and marine business, respectively. So for the pro down, the one I've recorded is the one from this statement. This one, the 300 there, and this 750. So let's take 50% and 80%. So it's all about 104. It's all about, this one was 1,047,510 times 50%. Then 80% of this amount, 1,945,920 times 80% times the 80% times the 80.
The first one is 523,755.
So that is 523.
755.
Then the second one?
1556.
That is
1556.
1556.
736.
736. So that is fine. So what you do next, you give me now the gross revenue. Up to this point, we have a gross revenue. So gross revenue. So that is a gross revenue after the computations. We are getting 823, 755, and 113. That is so this one will be 1,139,184. So the next area whereby we are supposed to move to is concerning claims. So for the claims, remember that we have to start from the net claims paid. So net claims paid. So the net claims paid. So remember that these insurers, they claimed against the risks which occurred, the insurers premium paid them. So the net claims paid, we have 418, 380, and 436, 715. So net claims paid. So 418, that is 380. And this is 836, 715, 715. 715. Then after that, after the net claims paid, we move to the net claims outstanding at the start. Remember, that is a brought down. Outstanding claims brought down. Because now the one which is brought down, remember, it was the one of the claims which was never paid in the previous period. So some claims which were supposed to pay in the previous period and they were never paid. So those are the claims we brought down. Those are the claims we brought down. We subtract from what has been paid this year. We subtract from what has been paid this year. So that's what I have. That is why I have to raise claims outstanding. Claims outstanding. Balance brought down. Balance brought down. Balance brought down. So if you can check from your so what we have done under these claims, we have taken the net claims balance brought down. So you raise the claims outstanding brought down. So you start from net claims paid, then you raise the outstanding claims balance brought down. That is from the previous year, the one which were never paid. You subtract from what has been paid. Then you add what has not been paid by the end of the year. That is what we call claims outstanding balance carried down. And it's under the additional information. It was number 8, or we call it additional information number asked in that question. So after you are done with the claims, you move to commission. You move to the commission. You move to the commission. So for the commission, we have here fire, and remember we have marine. We have fire and marine. We have fire and marine. We have fire and marine. So commission, remember that in some questions you will be given commission accepted and commission ceded. Commission accepted and commission ceded. But on this question, they never provided that. They just gave you the net commission. They just provided net commission. They just provided the net commission paid. So they just provided this. So that is what we have to record. So for the net commission, that is it was 25,995, and we have 530. So that is 52,035. 52,035. So this is C, because there is nothing else we have to adjust here. Then we have to talk about expenses. We have to talk about expenses. So for the expenses, remember we have to deal with the expenses which are more specific. The specific expenses. That is, when I say specific, the one which are concerning fire and marine only, because the general expenses will go to the general income statement. So for this scenario, if you check in your first additional information, let me start from additional information. The first additional information, what the examiner said is that management expense are to be allocated to fire and marine. So the management expenses was management expenses. So this one. So was supposed to be allocated, because now it's specific. When they say it's supposed to be allocated to fire and marine, that is specific. On the basis of net and the premium. On the basis of net and premium. On the basis of the net and the premium. So however, an amount of 150 million of the management expense is to be charged to the profit and loss account for the year ended 31st December 2008. So however, an amount of 150 million is of the management expense is to be charged to the profit and loss account. 150 of that management. So it's like 150,000 because this statement is in terms of thousands. So out of the total of 1 million and something, 1,310 shillings, 150 is supposed to be allocated to profit and loss account. That is general income statement in short. So let's allocate first these management expenses based on net and premiums. Net and premiums. So the net and premiums, if you can add the two, this is the net and premium. These are the net and premiums. So what you do, add those two. So 1047. It's like now that is our ratio of allocation. That is our ratio of allocation. So you need to get the total of that ratio. So I'm getting 29.93 for 30. 29.93 for 30. So management expenses. So I'm going to allocate this way. So remember that it's allocated based on this. So that is the first one was 1,047,510. So the total of the two is 29.93,430. So what you do, you multiply with now the management expense. Management expense was 13. It was 13,310. But they said what? 150 was supposed to be allocated to where? To general income statement. So out of that 1,313,310, you have to subtract 150. So the same with the second one. So 1945, 920. You divide with the total of the two, which is 2,993,430. We multiply with the relevant management expense, which is 1,313,310. But you have to subtract the 150 of this amount, which was supposed to be allocated in the profit and loss, which is an income statement. So that one can never be under the revenue account. So you can do the relevant computation. So after allocating the 1,313,310 and considering the 150,000 which is going to the general income statement, we are getting for fire the 407,084 shillings, and for marine 756,226. So we have to check if there's another expense. If there's another expense. So for here, for this scenario, I cannot see any specific expense. For now, I cannot see any specific expense. So the only specific expense which was relating to fire and marine was that management expense which they provided, and they gave us an option on how to share. So which means that up to this point, remember this is now will be D. So we can be able to get underwritten. So we have to get underwritten profit or loss. Underwritten profit or loss. So for the underwritten profit or loss, you say A minus B minus C minus D. A minus B minus C minus D. So you can do the computation. So which means that we are getting underwritten loss of 162,434 for fire, and the 610 and 237 for marine. So after we are done with that, we move to the income statement. We move to the income statement. Now we go to the next thing, that is income statement. So the income statement, we always start from the income. We always start from the income, or at the same time it can be a loss. So which means that under this we start with the underwritten profit. So underwritten profit or loss. So underwritten profit or loss, remember that it was concerning fire and marine, and already you provided me with 162,434. It was 162,434 and 61, that is 610, 237. So this one was underwritten losses. So give me the total here. So that after that you add other incomes. So the total of the two. The total of the two there. If there's someone who has added, you can give us the answers. Then after that, we talk about investment incomes and other incomes. So those are some of the other incomes I can see here. So we have the investment income of 510, 540, not 510, 540, and other incomes of 131, 730. So we have investment income and we have other income. We have other income. So investment income, so 540,000, and we have 131, 730. So if you add this, your answer here is ball. Your answer there is
772, 668.
772.
671.
So if you add these two now, 540,000 plus 1. So this is 671, 730. So this one will reduce your loss to say minus 772, 671. So that is remember to mute your mic if there's your background noise. So that is 100,000 and 941. So that these are gross income or loss. So after that, we erase expenses. Let us subtract expenses. So we have management expenses, the first one. So the one which was supposed to come here, the 150,000. The 150,000. So you remember, I subtracted this 150 from the 1,300,000 something when we were sharing that amount under fire and marine. So it was supposed to be recorded under the income statement. Then other than these management expenses, we have other expenses which are general. We have other expenses which are general, right? Which expense? So right now here, what I've done, I've recorded this 150. Then we have note 3, depreciation on motor vehicle and equipment is to be provided on reducing balance basis at the rate of 20% and 10%. So under this question, we have motor vehicle here. Already it's under net book value. So when we talk about reducing balance method, remember that you have to take cost minus accumulated depreciation in order to get these figures which you are given here. But already they have catered accumulated depreciation. For them to get net book value, already they have subtracted accumulated depreciation. So that's why they were saying on reducing balance method. On reducing, when it's on a straight line, method, we always multiply with what? At what? The assets will be stated at, let's say it was at a straight line.
At cost.
The asset could have been stated at cost, but now since it's at reducing, this is at net book value. So if they could have provided accumulated depreciation, they could have said this, for example, motor vehicle at cost, so that they give you accumulated depreciation, so that you take that cost, you minus accumulated depreciation, then you multiply with this rate, which you are given there. But already they have done that. So the only thing I have to do is taking my percentage of 20, we multiply, like now for motor vehicle, with the 7,500. And for equipment, I take my 10% according to note 3. I multiply with 108,105 shillings. 105 shillings. So depreciation on the two. That is how we are getting our depreciation by using 20% and 10% on the net book values, which we are provided for the relevant assets. So another expense maybe which was there, another expense which was there here, another expense was present on this line. So we can clear a bit to make it neat. So for the additional informations, we are done with the expenses which are there. So for the statement we are given here, so there's this bad debts written off. The bad debt written off, so 37,500. Is there any other expense you can see? So that is a bad debt because treasury bill, treasury bonds, deposits, on the due from that. So that is the only expense I can see there. Above there. So it's only the bad debts written off. It's only the expense which is remaining. So bad debts written off. So the bad debts written off, that is at 37,500. So what you are supposed to do, add those expenses and give me the answer there. 150,000 plus 1,500.
199,810.5.
199,810.5.
0.5.
Yes, subtract it from. So remember that now these are loss and these are an expense. So which means, right? Your net loss will be more. So you add the two. Because that is a loss and this is an expense, which is now again. So it's like now you take this and this you add. If you add the two,
300,751.5.
that is 300.
751.5.
These are net loss.
51.
It's fine. So then you add the retained profit. Add the retained profit for the year. Retained profit brought down or earnings. So what they retained from the previous year, which will be a brought down balance for the current year, which is a brought down for the current year. So a brought down for the current year. So which is the balance here? Which is the retained profit here? So it's this one. So the retained profit. So you can see it's 225,000. So 225,000. So you will remain with a retained earning, which is a negative, which is a retained loss. So these are like accumulated losses, which the company has been accumulating. So retained earnings. So these are loss.
$75,751.
That is 75.
751.5.
So that is fine up to that point. So what?
Negative.
It's a negative. It's a negative. That is a loss. So let us do now the statement of financial position, so that I introduce another question. So Kinga Limited. So statement of financial position. So the statement of financial position as at 31st December 208. 208. So we have here shillings. So we have non-current assets. We have the non-current assets. So for the non-current assets, you will check. We have motor vehicle. So remember, motor vehicle was 7,500. It's even here. So you minus the depreciation of 1,500. Then the next thing is equipment. Again, equipment, we have this one. We have 10,810.5 minus, not 0.5, it was, this is 108, 105 minus 10,810, so minus 0.5. Remember that this is depreciation we are subtracting. And then there is this treasury bonds. Treasury bonds. Treasury bonds is an non-current liability. Then treasury bills is a current, not a current. I don't know why I'm saying liability and it's an asset. So treasury bonds is a non-current asset. Then treasury bills is a current asset. It's a current asset. So the treasury bond, treasury bond. So the treasury bond is 85. 85,375. 85,395, not 375. 395. So then we talk about current assets. So under current assets, I've said the first one will be my treasury bill. Treasury bills. So that is all about for 149. We have 32.50. So that is around 1,493,250. Then another asset you can see there. Deposit in banks. So that was the money of the insurance. Maybe it deposits some money in the bank. So that is the money it can go and withdraw from the bank anytime. Like now, the money you have deposited in any bank, that is not the asset to the bank. It's a liability. Customer deposits in the bank, that is a liability to the bank. And the loans and advances which the banks gives out is an asset to the bank. So that one we'll be talking about it when we do banking. So deposits in banks was 3.5. So they have deposited 3 million. This insurance firm. So this one was 3 million. And that one was 3 billion. That was 3 billion because this one is in terms of thousands. So anyway, for now we are recording in thousands. So it's 3,555,750. Then after that, another asset you can see there. So we have a amount due from other insurers. Amount due from other insurers. So that is another current asset. Amount due from other insurers. So that is like premiums which the insurance firm expects to receive. So that is an asset to them. So 52,050. 52,050. So that is what I've been recording there. So you have recorded treasury bills, deposit in banks, and amount due from other insurers. So up to that point, we have a total assets. So after the total assets, we move to equity. We move to equity and liabilities. We move to the equities and liabilities. So equities and liabilities, from my question here, I can see that we have ordinary share capital. These ones, you know, the equity components. There's revaluation reserve. These are direct from the statement you are provided with. So these are revaluation reserve. And remember that the retained loss we have to subtract. The retained loss we have to subtract there. So let me display again for the ordinary. So ordinary. Let me show you where it is. Where it is. So it's at the start there. So
900,000.
900,000, and revaluation reserve is 300.
75,000.
And we have a 75,751.5. So that is a concerning retained loss. So this one I have recorded a long figure. Oh, it's fine, it's fine. So that is okay. Yes, that is fine. Eh? That is fine. So, and I have subtracted this, the one which we got from the income statement, the 75,751.5, the retained loss. And then after that, was there any non-current liability? There was none. In the equation, there was no non-current liability. Then let's move to the current liabilities.
There was a bank overdraft.
That is our current. That is a current. That is a current. Even amount due. Amount due to other insurers. So this is like a claim, which the insurance firm is supposed to pay. So this one, if you can check in that question, it's 30,000. Then the bank overdraft, which Bora has mentioned, you have the bank overdraft. So that is 120,000. After that, we have so these are the ones which were direct, the amount due, and the bank overdraft. Those are direct from the statement here. So the one which are a bit direct. So bank overdraft is down here. So this one. Then we have amount due to other insurers. Then other than these two, I would have to record the provisions they made for the unexpected, unexpired risk. The provisions which they made for unexpired risk, that one is treated as a liability. So the provision they made for the, remember, provisions are liabilities. So provisions for unexpired risk. So it was based on certain percentages. So what you do, you pick the balance carried down there. So 523,755 plus 1,556,736. Someone to add and give me the total. The one I have displayed, provision for an expired risk, balance carried down. Because this statement is prepared as at the end of the year.
2080 for 91.
2080
For 91.
491. Then finally, we have those outstanding claims, or we call them intimated claims, which have been approved but they have not been paid. Remember, that is a liability of the insurance firm. So the outstanding claims, so the outstanding claims, the one which is the balance carried down. Because these are the claims which has been approved, but the insurance firm has not paid them. Sometimes we call them intimated. So if you get a question where they call it intimated claims, they give you the date, you know that those are the one I'm talking about. So again, someone can add for me these two, 675 and 1185,000. So claims outstanding balance carried down. So 675,000 and 1,100,000. Someone to earn.
1860,000.
That is 1860,000. So up to that point, we are done. So confirm it if it's balancing. So this is all about total equities and liabilities. So our question is balancing at 5,289,739.5. So that it marks the end of the question of August 2009.